Hello and welcome to this podcast. Leasing is one of the more complicated topics in our syllabus, especially when we start mixing in income tax and VAT in the same question. So I thought I'd run a series of podcasts on leasing and the taxation of leasing. I hope you find them helpful. In this first podcast, we're going to look at the basics of leasing, and we're going to ignore the VAT implications for now. That'll follow in a later podcast. At the outset, it's important for us to differentiate between leasing in an accounting context and leasing in an income tax context. We're used to thinking about the accounting context, where we have finance leases and operating leases. Operating leases are rental agreements that we deal with month by month. The asset remains on the balance sheet of the lessor, and the lessee has a rent expense. Finance leases include two kinds of contracts. There are those that are a sale with a financing agreement, and the ownership of the asset really does transfer to the lessee, and there are those where the ownership of the asset remains with the lessor, but because the control over the asset, the risks and rewards of ownership, effectively now are transferred to the lessee, we treat that as an asset of the lessee and recognize the asset and a financing obligation on the balance sheet of the lessee. In income tax, we don't apply this substance over form approach. In income tax, we look at the legal form of the agreement, which means that all agreements where ownership remains with the lessor are categorized as leases. The only other category we have is for suspensive sales, or we might refer to purchases in an installment credit agreement. Those that really do have a sale and a financing component. That means that not all finance leases are treated as suspensive sales with a financing component for income tax purposes. All operating leases would be classified as leases for income tax purposes. Some finance leases would be treated as suspensive sales, but others will be treated as leases. What does that mean? Well, for income tax, if what we've got is a suspensive sale or a purchase in an installment credit agreement, the seller purchases the asset and claims a Section 11A deduction on the assumption that what they're purchasing is their trading stock. They then have gross income of the cash price of the asset when they sell it to the buyer. And then over time they have interest income as the buyer pays off the financing of the sale. The buyer now owns the asset, and the buyer is entitled to claim capital allowances for income tax purposes. The buyer then has interest deductions over time as they are paying off the debt of this asset. However, on a lease, the asset remains the asset of the lessor. The lessor claims the capital allowances, and the lessor has rent income. The lessee only has a rent expense and nothing else. So sometimes those will match up with the accounting treatment, but other times they will be different. There are also some further considerations when we talk about leasing and capital allowances. First up, a leased asset might qualify for a Section 12C allowance, but it doesn't qualify for the 40% in year one. That's because when you go to the paragraph that speaks about 40%, it refers only to selected 12C allowances, specifically those where the owner of the asset is claiming the allowances or where the owner of the improvement is claiming allowances. It doesn't bring in those categories that speak of assets being leased. And remember, here we're talking about leasing in the income tax context. Secondly, Section 12C is only available the first time an asset is brought into use by the taxpayer or the first time the asset is brought into use by the lessee of the taxpayer. So you can't claim Section 12C for a sale and leaseback transaction because the seller then becomes the lessee and they bring that asset into use for a second time. Then Interpretation Note 47, which is the interpretation note that deals with Section 11E, has some things to say about leasing. First of all, it says that the amount on which you're going to base your Section 11E allowance, if that's the correct section to use for your allowance, should be based on the cost less any residual value provided for in the lease agreement. That's because 11E is supposed to represent the decrease in value of the asset due to use. Well, if the contract provides for a residual value, then presumably that residual value is what will remain at the end of the contract. So the asset is not losing that portion of its value. Secondly, Interpretation Note 47 says that if the lease is for a longer period than the write-off period that SARS grants under Section 11E in Interpretation Note 47, then you should use the longer period for your Section 11E deductions. The logic being that if the lease is for a longer period, then surely the life of that asset is longer than the write-off period that SARS would normally grant. Alternatively, Interpretation Note 47 says if the lease period is shorter than the period that SARS normally allows a write-off for, you should use the SARS longer period, the assumption being that you would then lease that asset out a second time when it's returned at the end of the first contract. However, if you can support a reason why you should use a shorter period, then you may be entitled to use that. So let's have a look at some simple examples where we can distinguish a lease from a suspensive sale agreement. So in this example, B rented a machine from A for 100 Rand for 3 years. B used the machine in a process of manufacture, and A had purchased the machine for 250 Rand. You're required to calculate the tax effects for A and B in year 1. So A is the lessor. A continues to own the asset, leases the asset to B, and is entitled to claim Section 12C, allowance on the asset. But because it's a lease transaction, they have to claim 20% in year 1, not 40%. Then A also has gross income, i.e. rent income, of 100 Rand in each of the 3 years. B's only tax consequence is a Section 11A deduction for the rent expense of 100 Rand. Let's contrast that to a purchase and sale example. So in this example, B purchased a machine from A in a suspensive sale for a total of 351 Rand, payable in annual installments in arrears over 5 years. The cash price of the machine would have been 250 Rand, and the interest rate in terms of the contract is 12.5% per annum. You're required to calculate the tax effects for A and B in years 1 and 2. And I've prepared an amortization table just to show how this asset is being paid off over time. So each of those payments represents an interest and a capital portion. Now in this example, A is the seller. A purchased the asset, and presumably it was trading stock to them. They bought it with the intention of selling, so they claim a Section 11A deduction when they purchased the asset. They then have gross income, and that gross income is calculated on the cash price, what they would have been able to sell it for if they had had no financing component. Here we've just assumed that they would sell it for the same price, so the only way they're making any money out of this transaction is through the financing. Then A has provided financing on this asset to B, and A has interest income in each of the years until the asset is paid off. B now owns the asset, so B is entitled to claim capital allowances. And because this is not a lease transaction, B is able to claim 40% in year 1 and then 20% in the rest of the years. B has interest expense, and so they show that as a Section 24J interest deduction. That's all we're going to cover in this podcast. In the next podcast, we're going to look at the VAT implications of these transactions. I hope you found it helpful.